TheoTrade. This is Don Kaufman. It's May 17th, 2019, and you are watching the TheoTrade Weekend Update. You know, I'm just a few minutes after the cash close here on a Friday afternoon in what has amounted to a tweet-tastic type trading week. That's kind of a shout out to all of you that traded on an intraday basis this past week, because if you did trade on an intraday basis, like I do pretty much on a day-to-day basis, you got taken out at least once by one of the tweets that effectively came out, whether it was the administration, whether it was China, whether it was European, auto tariffs, you name it. It was a tweet-tastic kind of a week. And yeah, I took a little bit of pain on a few of those tweets, but again, the big irony was today being Friday, there was sell-side activity caused by the tweet, and I caught every single ounce of that sell-side activity. With that, let's actually switch to really what happened throughout the course of the week, and more importantly, what we can expect, of course, moving forward. You know, one of the things that really stands out in trade, kind of an overwhelming theme, and I was talking about this a lot on the Wednesday video, the narrative has now changed inside of the marketplace, and that narrative, it's shifting a lot from what's going on, of course, with China and the tariffs. Everybody all of a sudden is talking about bonds. Listen, bonds, they've set the stage. They've set the dinner table, if you will. And what I mean by that is, listen, if risk is going to come into this marketplace and things are going to just get outright nutty, well, the bonds are already trading like that's going to effectively happen. It's just that implied volatility, or the volatility futures, or the VIX, okay? Those are not necessarily kind of in cahoots with what the bond market is saying, but over the years and a whole lot of experience tells us that the bond markets are a really effective means, okay, of kind of gauging risk to the future. So with that being said, in the near term, okay, we have to be extraordinarily careful of wild sell-side activity in the broader S&P 500. Now, granted, I'm bearish, and I've been bearish for a considerable period of time, but my bearishness is over the duration, and I constantly reiterate that. I'm not bearish like tomorrow, but the bonds right now, they've set that kind of dinner table for getting bearish in the very near term. Now, one of the things that I was mentioning a moment ago is that implied volatility inside of the marketplace, it's really lacking. When I'm talking about implied volatility, here's an example. The SPX, right? So the SPX, it's the mother of all options products. And the SPX, that's where the VIX is, of course, gauged. And, the VIX, throughout the course of this week, yeah, it picked up a little bit earlier in the week, but we've been sitting in the 15 and 16 handle, yet we've had these really expansive ranges. And when I do get to the charts here in a few minutes, I'm actually going to show you kind of what I'm detailing with expansive ranges. Like, specifically, what does that mean? I'm actually talking about actual price movement, okay, in the markets. Actual price movement in the markets is relatively high, but implied volatility, it's just not there. So the example I was going to give you is in the SPX, there's a Monday, there's a Wednesday, there's a Friday expiration. And the one thing that was really striking to me, if you look at this weekend coming into Monday, the Monday expiration in the SPX only has 11.2% implied volatility. It's like the marketplace just saw risk, pouring out throughout the course of this past week, and on Monday it's like, oh, it's a yawner. It's a complete and total yawner. And I'm looking at this, I'm thinking like 11.2% volatility, right? I mean, net, I'm going to want to be a buyer of options coming in on Monday. Why? Because, we're what? 1 second away from another tweet out there that's going to be rocking markets. Moreover, I was thinking about this weekend. This weekend's very likely to have some China retaliation, if you will. At least Apple's been pricing that in. So, kind of moving forward, again, I'm looking at these implied volatilities. They're just not doing it for me. And again, I'm going to show you historical volatility here in a couple of minutes when we get down to it. I know I'm kind of geeking out a little bit with implied versus historic, but the bottom line is that bonds, they're displaying, again, risk is imminent, risk is here. I mean, come on, the bonds are sitting right around the 150 range. You have the yield curve that's completely flattened out. Like banks, you're going to have a tough time being able to make money in that kind of environment. Yet, implied volatility, it's what? It's yawning, right? And every time implied volatility, picks up, all these traders rush in, sell. And I got to tell you, I just don't see the edge right now and be able to sell options premium in, for example, like the Monday expiration, 11.2% implied volatility. The historical vol, over the last 5 days, okay, that's backward looking, but historical vol over the last 5 days in the SPX has been 22%. 22%. And yet we're pricing 11% implied, okay, for Monday. Big catch 22 over there. It doesn't pay right now to be a seller of option premium. Net pays to be a buyer of option premium. Now, there is one volatility instance that's getting interesting, and that's the VVIX. The VVIX here on Friday afternoon, it closed in and around like the 99-100 level. And why that's interesting is effectively traders came in and they bought volatility late on a Friday afternoon, again kind of anticipating risk. Although if we're anticipating risk, how come the implied volatility hasn't gone up in the SPX options? Again, it's another one of these like catch-22s out there. Now the marketplace as a whole, although we're seeing these expansive ranges, and you know, when I talk about expansive ranges, for me, I do like to trade a lot on an intraday basis. I take all kinds of in-out spreads, some duration positions, but on an intraday basis as a trader, I can't ask for anything better than 40 and 50 and even 60-point ranges throughout the course of this week. That is the S&P futures. They were literally like Mr. Toad's wild ride. But, you know, overall, the markets didn't fare that bad this week. I mean, the S&Ps were down negligibly. The Nasdaq got hit a little bit harder, but the area that we're going to look at here in a few moments, the Russell, because the Russell actually closed outside of the expected move. And I tend to remind everybody that, you know, very often the Russell kind of reacts, okay, and you see it reacting prior to some of the other major products that are out there, being the Nasdaq and of course the S&Ps. So is the Russell a sign again of volatility and really markets starting to break down? Okay, well, not necessarily yet, but again, we're going to show you a little bit more in depth that the Russell did effectively close outside of the expected move. And the implied volatility in the Russell, it's kind of rocking out there. So as I said, I'm kind of geeking out on you guys a little bit here, but there's a lot, again, I think that's going on beneath, if you will, the surface of this marketplace. You know, the last thing I want to talk about is expected moves specific to the SPX. The SPX this past week of trade had about a $54 expected move. This coming week of trade, all right, is right at around $52, $53 of expected move, meaning that the SPX is supposed to stay, okay, in a $53 range higher or a $53 range lower. Now, it's not surprising, even though we had some big movement this past week, it's not surprising to see that in this coming week. And why I say that is because we're about to come into Memorial Day weekend. Now, it's still a full 5 trading days this next week, but listen, by Friday afternoon of the coming week, and that's when everybody's like, that's it, I'm out of here. It's like the first weekend in the Hamptons. If you know you're a if you're a New York trader, I don't know. Is that where they go? Is that where they go these days? I think it's Montauk now. Nevertheless, a lot of traders, okay, they hang it up. They head on vacation. School is out for summer, but we are heading into Memorial Day weekend, and I like this because we're actually heading into summer with some decent volatility. Let's get into it. Let's look at a couple of specific charts, a couple of specific trades. To the charts and trades we go. Allow me to start here on the SPX, discussing a little bit about the expected moves. As I was denoting just moments ago, this past week of trade had right around a $54 expected move. This coming week, which has already been priced forward, it's about a $52 expected move. So why I'm actually displaying this and why I'm spending some time on this is simply because the historical volatility, which is actual price movement inside of the SPX, is, okay, really categorically speaking, large right now, especially considering the entire week is expecting like this $52 move, but we're getting that kind of action almost on a day-to-day basis. In fact, for that, I'm going to cruise over for just a second to the S&P futures, and I just want to zoom in, okay, on just the last, 2.5 weeks of trade. When I talk about expansive movement in here, I mean, you don't have to look much further than, for example, this particular candle, and we'll just look from like the high to the low. That's roughly what, 2870. Okay, this low down here is roughly what, 2800. I mean, think about that, 70-point range in one trading session, followed by what? About a 50-point range, followed by, again, another 40-point range. And yet, when you cruise over to the SPX, again, the entire week is pricing in this $54 move. I guess ironically, well, we stayed in that $54 range this past week. But the point, again, that I'm making with this and that I want to show you here momentarily is we're going to cruise over to studies. and we're going to go to add study, and we're going to go down to volatility studies, and we're going to pull up historical volatility. So the annual standard deviation of past stock price movement. It just means actual price movement in the marketplace. Now, when you look at historical volatility, kind of averages it. In this case, it's averaging it over 20 days. I'm going to go ahead and change that. I want to look in the near term over here because I'm measuring these expected moves on a week-to-week basis. So I think it's appropriate to just knock this down to a shorter time frame. In this case, we're just going to look, okay, at a 5-day period. All right, at a 5-day period, and we're going to average that 5-day period together. And what that effectively says is that the SPX, okay, is moving at a rate, and we'll just cruise this over to right there, okay, what? North of about 20%. In fact, you can kind of highlight and look in here. It's 22.3%. Now, again, some of you maybe don't necessarily read into implied volatilities or historical volatilities on a day-to-day basis, okay? This can be quoted in percentage terms. It means 22.38%. So like a 22%. Now, again, that's just over the last 5 trading sessions. But how does that kind of blend with what we term implied volatility? Now, implied volatility, and when I'm talking about like implied and historic, this is not perfect to look at one versus the other. But again, the point that I'm trying to make is the previous 5 days of trade that we just saw, that means this past week, we saw moving at a rate of about what? 22% vol, right? And then all of a sudden the implied volatility for this next week of trade is only like 15.75. So what I'm getting at with this, this historical volatility, which again is actual price movement, is really freaking high for the amount, okay, that the implied volatility would be paying you to take that type of risk. I was also kind of detailing here just moments ago in the video portion. I was talking about the Monday expiration. Here's that Monday expiration. Check it out. That's Monday's expiration. Okay. This thing is now, it's under 11%. I was just talking about a moment ago, it was 11.2%. Again, some of these settle out just in the last few minutes of trade. I mean, like what? A 10.9% volatility. Okay. We could have China retaliating this weekend. And yes, I'm being very index specific right now, but people, it doesn't stop there. Let me show you a little bit deeper into this, because we're talking about, a couple of charts, a couple of trade ideas. One of the major ideas in this coming week of trade, right, is I want to be on the buy side of options. I've been doing it a lot the past couple of weeks because it's been extraordinarily advantageous, especially on an intraday basis, which I'll show you here momentarily. But let me first cruise over to something like Apple. Why am I going to Apple? Open up like option statistics. What's option statistics? Okay, well, one of the things you can actually see here in option statistics, all right, is IV percentile. Now, Apple, okay, I kind of took it on the chin a little bit more today, but just take a quick look at the chart on Apple. All right, in this particular circumstance, and you know what, I'm going to clear this off. Okay, Apple has been, well, getting whacked back a bit lately, but on a percentage basis, when you start looking at this, all right, it was up almost, 35% 2 weeks ago. Now it's only up, let's just call it 20%. This thing's gotten whacked by, hey, let's rough numbers over here, okay, napkin math, 10 to 15%. On a 10 to 15% hit, you'd think, okay, that the IV percentile would rise up. What is IV percentile? Okay, it's looking at the implied volatility now versus the previous 52 weeks. And when it says like the 45th percentile, it's ranked, okay, like, well, you can say this, below average. It's got like below average implied volatility, even after the stock got whacked back considerably. Another one that's also looks this way, look no further than Tesla. I mean, Tesla, that's ugly. You wouldn't even ski down that slope. This thing is down now 32% on a year-to-date basis. Okay, this is falling off a lot of people's radar screens. But the point that I'm making inside of Tesla, check this out. Okay, it's in like the lower 1/3. Now, again, for those of you that don't necessarily read into like IV percentiles, for this one, you can kind of cruise up, and I'll just take you through an easy way to do this. Go over here to study, go to volatility studies, come up to implied vol. Okay, I'll just make a quick point. Implied vol, and we're going to knock this to a 1-year chart. All that I'm saying inside of Tesla, if you look at where Tesla's volatility is right now, okay, it's not even middle of the road. It's actually in like the lower, like 1/3 of all the implied volatility instances of Tesla this year, okay? And we're seeing this again and again and again. I mean, I can bring up like Caterpillar, Okay, why not? Why bring up Caterpillar? I don't know. Caterpillar's getting absolutely smoked in the last. This is 3 weeks of trade. Today, it got downright hideous. Downright hideous. You know that over again a 1 year period. Okay, Caterpillar's down some 20%. Can you see that reflected in its implied volatility? And this is what I'm trying to get into over here. It's like a suppression, okay, of volatility, a suppression of implied volatility that every time, okay, every single time that implied volatility tries to pick its head up, look at this, Caterpillar's getting killed. Usually when stocks are getting hammered to the downside, implied volatility picks up. Well, implied volatility, it's dead right now. And the reason, again, I'm detailing this is not only because I think it can make you, first of all, rationalize that you probably should not be selling options. Number two, rationalize that being an option premium buyer right now, it's absolutely the place to be. Now, I can go out there and I can scan for all kinds of stuff with high implied volatility, okay? But I might be scanning myself into, a risky oblivion. But the point, again, that I'm really making with this is I don't trust implied volatility in the overall marketplace as far as you can throw it. I just don't trust it right now. I mean, I look at something like the VIX. I'll clean this up a little bit. And the VIX just stared at risk and just keeps right on laughing. Okay, but at the exact same time, and this is what I started, discussing a little bit earlier. Okay, the bonds, I have a tendency to trust the bonds, and the bonds, they just haven't had a downtick in a month. I mean, we're a month of just upticking, and again, the higher those bonds uptick, the lower the interest rates continue to go. I mean, we're at a point right now where you have to start pulling up like a 3-year chart to see if interest rates, we're going to break all the way down to like 2%, okay, on the 10-year. Listen. Somebody has got to be wrong in this marketplace. Somebody's got to be wrong. Either it's the bond market, okay, or it's the equity market. And at this point in time, listen, I've seen the equity market kind of sell off a little bit, implied volatility just not picking up. I'm going with the bonds, okay? And the way that this is very likely to play out, okay? Let's get into some really specific details right now, some tactical details. All right, cruise over to the spiders for a second. If you take a look, the spiders on the week, and I'm actually going to put on auto expected moves so you guys can see this for a second. If you look at the spiders on the week, this was the full week of trade. Okay, the spiders, this is exactly where they started. Here's where they ended. Not a horrific week to the downside. And again, all I'm trying to do is just kind of give you orientation of where the week started, where we actually kind of ended, right? So the spiders, they got knocked back a little bit, okay? But then when you start compare that to the Nasdaq, the Nasdaq things got a little bit more serious, so which makes sense because Apple got hit. This is where the week started in the Nasdaq, and this is where the week ended in the Nasdaq. The Nasdaq, very similar to the S&Ps in most respects, but the Nasdaq lost a little bit more on a percentage basis. And last, but definitely not least, here's the Russell. Okay, the Russell just got downright whacked. That's this is where the week started, and yeah, we ended out here. That's outside the expected move on the Russell. The reason I'm actually displaying this is because the Russell right now seems to be feeling the impact not only, okay, of maybe some of the tariffs, which is interesting to say the least, but the regional banks, okay, are loaded up inside of the Russell product. Yet at the exact same time, I'm talking about regional banks. If I go over to the financials here, the financials, they too actually closed outside of the expected move. All of this actually leads us to right here, specifically to the financials. Now, let me clean up the chart and actually show you something. As I was saying, okay, bonds have kind of set the stage for this next week of trade. Yeah, well, that dinner table, though, is really going to be served up in the S&Ps with the XLF, and I'm constantly keying into the XLF. It is make or break time inside of the XLF. Right here is the 2650. We literally touched into it on Wednesday's trade, ripped higher. Okay, coming into Friday, we're heading right back for it. It's coming right for us. If you take a look at the next week of trade, we have, again, this one's actually got some implied volatility, almost a 60-cent expected move. Almost a 60-cent expected move, which takes us right into the wheelhouse of the 2650. And again, that 2650, it's an inflection point, not just for the financials. It's an inflection point, okay, for the entire S&P 500. If you want to know the next step that this market takes, okay, put aside for a second what a stock like Apple is going to do. Listen, it is very likely, it's very plausible that China is going to retaliate around, okay, Apple. We just took a shot at Huawei. They're probably going to take a shot at Apple. Great. Okay. Move forward from that. Apple's market cap will definitely injure the Nasdaq to a degree, but in a broader sense, okay, those bonds are just going to be taxing the financials. And Apple can't break the back of the S&Ps, all right? The financials absolutely can. So again, tremendous amount to think about in this next week of trade. But one of the things that I'm looking for is any bounce, for instance, inside of the financials. I'm going to look to kind of re-up a few shorts in there. And, part of me absolutely wants to see, again, I've got duration positions on and I've got lots of duration bearish positions on. Like I don't, deviate from this at all. These are what I term, okay, this is duration. These are a bunch of bearish positions. All right. I mean, today the S&Ps are down some 17. It's up about $2,000 just on the duration positions. And yes, I want those duration positions, okay, to have long-term viability. And yes, a big portion of me wants to see the S&Ps break a lot lower here, okay? But in the near term, I almost want to see a bounce. I want to see a bounce because I am looking to re-up a couple of shorter-term short positions. I mean, you're starting to get products like Caterpillar. This thing's in oversold territory. There's just no question about it. I mean, whatever technical analysis you want to bring up, look at this thing. This is an RSI Laguerre. It's actually dead. It is maxed out on the zero line over here. I can go through 10 different stocks. There's some stocks that, first of all, you could even take bullish positions if you think they're going to bounce. Okay, but I think it's dangerous trying to look for the bounce trade. What I'm going to look for, okay, is the bounce trade to actually short into. Okay, and a bunch of underlyings, I've been looking for that specifically inside of Google. Google, it needed more follow through, maybe a bounce up to 1200, and I was looking for a short. Amazon, okay, Amazon actually took a pretty good hit. All right, let me turn that off over there. Oh, it's got all kinds of signals. Amazon actually took a pretty good hit in today's trade. If this was it for the bounce, then maybe we missed it. Okay, but right now, again, the duration positions, they're working. In the short term, we need a bounce so that we can step in and short, again, using in-out spreads and so forth, which is, again, buy side of premium, in-out spreads, to take advantage of some short positions, again, right here, right now. A lot to think about in this weekend's video. Again, be mindful. Those bonds, people, they have set the stage for a broader sell-off inside of the S&Ps. Right now, it's whether, again, the financials are going to take the bait and run with it and break the back of those S&Ps. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful